Dola, 5.65 billion. That's what Blackstone just paid for a company that owns nothing but docks, pilings, and parking spots for boats. 21 times its annual profit. A multiple you'd expect from a hot software startup, not a business built on wooden planks and gas pumps. So what exactly did they buy? A marina. Rows of white hulls swaying in the water. A guy in a polo shirt walking the docks with a clipboard, collecting rent from people who use their boats maybe 6 days a year. No inventory, no manufacturing, no angry customers demanding refunds. The water was already sitting there for free. Someone just roped off a piece of it and started charging admission. On paper, it looks like the laziest cash machine in real estate, and almost nobody can build a competing one. The permits alone can take years if they get approved at all. That scarcity is exactly why the smart money keeps piling in. But here's what none of the brokers put in the brochure. You're not actually renting boat slips. You're renting a piece of ocean you don't own. Sitting in the one spot on the map insurance companies are most afraid of. So what does it actually cost to get in? At the small end, brokers value marinas the crude way, dollars per slip. Anywhere from $5,000 to $15,000 a slip, depending on whether it's a covered premium berth or a bare piling in a back channel. Run that math on a modest 200-slip marina, and you're looking at somewhere between $1 million and $3 million just for the dock infrastructure. Before you've bought a single fuel pump or hired a single dockhand. Bump up to the institutional tier, and the numbers change entirely. Coastal marinas in strong markets trade at cap rates of 5 to 8%. That sounds unremarkable until you compare it to almost any other commercial real estate sector, where investors demand higher returns because there's always a chance someone builds a competitor next door. Nobody's building a competitor next door to a marina. You can't just go get a permit and dig a new one into the coastline. Environmental review alone can take years, assuming it gets approved at all. The supply of marinas in America is, for practical purposes, fixed. That scarcity is the entire investment thesis, which is why the big money has been circling. In 2020, Sun Communities bought Safe Harbor Marinas, 101 properties, the largest marina platform in the country, for $2.1 billion. 5 years later, in 2025, Blackstone bought that same platform for $5.65 billion, 21 times the estimated annual funds from operations. Read that again, 21 times. That's a multiple you'd expect from a software company, not a business built on wooden docks and gas pumps. And there's a newer, even more capital-intensive tier now: automated dry stack storage. Picture a parking garage for boats. 3 to 5 stories of steel racks, a forklift that plucks your boat out of storage and drops it in the water on command. A dry stack facility can hold 300 to 500 boats on the same footprint that would normally fit maybe 50 to 80 wet slips. More boats, same acreage, dramatically higher revenue per square foot of waterfront if you can afford to build it. So the entry price ranges wildly. A few $100,000 buys you a fixer-upper marina in a sleepy inlet. A few $1 billion buys you the Safe Harbor platform and its scarcity premium. But every tier shares the same underlying trap. None of them are actually buying the water. They're buying the right to use it. A right that, as we'll get to, the ocean itself can revoke without warning. So where does the actual money come from? Because renting boat parking barely scratches the surface. A well-run marina is stacking at least 5 distinct income layers on top of each other. And most of the real profit is hiding in the layers nobody outside the industry ever thinks about. Layer 1, the foundation everyone assumes is the whole business: wet slip rentals. You dock your boat in the water. You pay for the space, simple as that. Except the pricing spread is enormous. A basic slip for a small boat runs somewhere between $10 and $35 per foot per month. A 30-foot boat, then, costs its owner anywhere from $300 to over $1,000 a month just to keep it tied to a dock. That's a 3-time swing for the exact same length of boat, depending entirely on which stretch of coastline you're parked on. Location isn't a nice-to-have in this business. It's most of the pricing model. Layer 2, yacht docking. Once you're in superyacht territory, the pricing shifts entirely. A large vessel can run a marina owner $1,000 to $1,500 a month from a single boat. A modest fishing boat pays $300 a month. A yacht 2 docks down pays $1,500. Same marina, same dockmaster, same water. The only difference is the size of the check the owner is willing to write to keep their boat somewhere impressive. And this is where occupancy dynamics get interesting. Marinas in prime markets don't just fill slips, they curate them. A waitlist for the good slips is common in high-demand harbors, which means owners can quietly raise prices year over year with almost no pushback, because the alternative for the boat owner is nothing at all. Layer 3 is where a lot of newer marina money is actually flowing, dry storage. Instead of floating in the water year-round, boats get stacked, literally, in massive steel racks, sometimes 3 to 5 stories tall, and a forklift lowers them into the water only when the owner calls ahead. Dry storage rents for $100 to $200 per foot per year. It sounds smaller than the monthly wet slip numbers until you realize the marina isn't paying to maintain floating docks, isn't exposed to the same storm damage, and can pack in far more boats per acre. That dry stack facility we mentioned earlier, 300 to 500 boats on the footprint of maybe 50 to 80 wet slips, isn't a marginal efficiency gain. It's the same piece of waterfront generating multiples more revenue just by moving the boats out of the water when nobody's using them. Layer 4 is the one almost nobody outside the industry thinks about, and it can be a genuinely surprising chunk of the business. Fuel sales, haul-out and repair services, and the ship's store. Boats need gas. Boats need their hulls scraped, their engines serviced, their bottoms repainted every year or two. And boaters, once they're standing on your dock, will buy rope, life jackets, sunscreen, and overpriced snacks on the way to their slip. Individually, these feel like rounding errors. Combined, fuel, service, and retail can make up close to 30% of a marina's total revenue. It's the difference between a marina that just collects rent and one that's actually running a small waterfront economy, where the boat is really just the customer's ticket in the door. Layer 5. Smaller in scale but worth mentioning, liveaboard slips. Some marinas allow a share of their slips to be used as actual full-time residences, people who live on their boats year-round. It's a premium arrangement, and where it's allowed, it can meaningfully boost occupancy revenue. Since a liveaboard tenant is effectively paying rent 12 months a year, with none of the seasonal drop-off you'd see from a weekend boater. But it comes with strings attached. Zoning boards and insurance underwriters don't love residential use of a commercial dock, so most marinas are legally capped on how many liveaboards they can host. It's upside, but capped upside. Then there's the seasonal layer running underneath all 5 of these, the one that separates a good marina operator from a mediocre one. Boating is not a year-round habit in most of the country. Occupancy in a lot of markets swings hard between summer and winter, and the operators who actually make money are the ones running dynamic pricing the way an airline or a hotel would. Raising rates during peak season, offering short-term transient dockage to visiting boaters passing through, filling empty slips during the off-season with storage customers instead of just eating the vacancy. A marina that treats its pricing like a static rent roll leaves real money on the table. One that treats it like a hospitality business captures it. Put all of this together, and here's the number that actually matters when you're evaluating whether a marina is worth owning. Revenue per slip. Top-performing marinas in premium coastal markets are generating somewhere between $5,000 and $15,000 per slip per year. Once you count every layer, not just the base rent. That's the real efficiency metric brokers use, because two marinas can have the identical slip count and wildly different economics, depending on how well they've stacked fuel, service, dry storage, and retail on top of the base dockage fee. Here's the thing about all these layers, though, and it's worth sitting with before we move on. Every single one of them depends on the same physical assumption, that the dock is still standing, the water is still calm, and the marina is still legally allowed to operate exactly as it did last season. Slip rent, yacht premiums, dry stack efficiency, fuel margins, live aboard upside, seasonal pricing, stack them as high as you want. They all collapse the moment that one assumption breaks. And on the coast, that assumption breaks more often than people think. Here's the assumption that quietly holds up everything we just talked about: that the marina will still be standing next season, insured the way everyone thinks it's insured, sitting on water it still has the legal right to use. All three of those assumptions can break at once, and when they do, it doesn't happen slowly. Start with the insurance problem, because it's the one almost nobody buying a marina fully understands going in. A lot of marina owners insure their property the same way they'd insure any commercial building, a generic windstorm and property policy, instead of a policy actually written for marina-specific risk. That gap doesn't matter at all until the day it matters completely. Here's the mechanism. When a hurricane hits a marina, the damage almost never has one clean cause. The storm surge rips a dock loose. The loose dock then slams into the boats tied to it. But the boats, tossing in the same surge, also slam back into the dock and the pilings. So now you've got two separate kinds of damage tangled together: dock damage caused by boats and boat damage caused by the dock, and two separate sets of insurance companies who each want the other side to pay for it. That's not a hypothetical. That's exactly what happened after Hurricane Isaias. Now, normally this is where the trap would just stay contained to an insurance argument. But it doesn't, because of the second piece of the structure. A lot of marinas don't actually own the water they operate on. The docks and the business sit on submerged land leased from a state or a municipal authority. That lease is usually the least dramatic paperwork in the entire deal. Until a catastrophic storm forces a full rebuild, and suddenly the lease terms, the permitting for reconstruction, and the government's appetite for a marina in that exact spot are all back on the table. At the worst possible moment, when the owner has zero leverage and a business that's currently generating zero revenue. So walk the domino chain all the way through. A storm hits. Dock and boat damage tangle together into a legal dispute instead of a quick payout. Insurers on both sides bring in their own engineers and lawyers before releasing a dollar. Meanwhile, the rebuild itself needs permits. The same environmental permits that made this such a scarce, valuable asset in Part 3. Except now they're required just to put back what was already there, and they can take just as long to approve. And underneath all of it, the submerged land lease that nobody thought about for the first 10 years of ownership is suddenly a live negotiation. While all of that is unresolved, here's what doesn't pause: the mortgage on the property, if there is one. the property taxes, and, increasingly, the insurance premium itself. Because coastal windstorm coverage has been getting harder to renew and more expensive to buy in exactly the markets where the best marinas sit. The very thing that makes waterfront property valuable is the same thing that's making it progressively harder to insure. Put a number on it to make this concrete. A rebuild that costs a few $1,000,000 doesn't sound catastrophic against a marina worth tens of millions, until you remember that a marina generating, say, $5,000 to $15,000 per slip a year isn't sitting on a pile of cash equal to a full rebuild. The rebuild cost can run several times the marina's entire annual revenue, arriving all at once, with the money to pay for it stuck behind a legal fight instead of sitting in the bank. This is the part the glossy brochure never puts on page 1. A marina isn't just a real estate asset with weather risk, the way a strip mall or an apartment building might be. It's a real estate asset, an insurance dispute waiting to happen, and a government lease all fused into one business, and a single storm can activate all three at the same time. Let's put a real address on everything we just walked through. August 2020. Southport Marina, North Carolina. Hurricane Isaias comes ashore, and by the time the water calms down, the marina is looking at a like-kind rebuild, replacing the docks exactly as they were, priced at just over $3.3 million. Now watch how that bill actually gets distributed, because this is the part that turns a weather event into a years-long legal war. The marina calculates the damage by lineal footage, basically, how much dock space each boat was taking up when the storm hit, and prorates the rebuild cost across 185 boat owners. One of those owners, with a 42-foot boat, gets a bill for $19,715, not to fix his own boat, to help pay for docks he doesn't own. Understandably, the boat owners don't just write the checks. 9 different insurance companies, representing more than 100 of those slip holders, hire outside counsel to investigate the claims on their client's behalf. One insurer brings in its own marine surveyor. Law firms send out roughly 150 separate letters demanding more information before anyone pays anything. What started as a single storm turns into a multi-front legal argument over exactly whose insurance is responsible for which piece of splintered dock, dragging on for years after the wind had already died down. That's the trap from Part 5, playing out with a real name and a real number attached to it. $3.3 million doesn't sound like much next to a marina that might be worth tens of millions on paper. But that number didn't show up as a manageable line item. It showed up as a legal standoff, with boat owners, their insurers, and the marina all pointing at each other, while the actual repairs sat waiting. Now, flip to the other end of the spectrum, because this business has a genuine best-case story too, and it's an even bigger number. In September 2020, the same year as Isaias, as it happens, Sun Communities agreed to buy Safe Harbor Marinas, the largest marina operator in the country, 101 properties across 22 states, for $2.1 billion. 5 years later, in February 2025, Sun Communities turned around and sold that exact same platform to Blackstone for $5.65 billion, roughly 2.5 times what they paid for it. Blackstone's number worked out to about 21 times Safe Harbor's estimated annual profit, a multiple you'd expect out of Silicon Valley, not out of a business built on pilings and gas docks. So here are 2 real stories, 5 years apart, both rooted in the exact same asset class. One is 185 boat owners and their lawyers, arguing for years over a $3 million dock. The other is a 101 property portfolio trading hands for $5.6 billion because the buyer is betting that scarcity and consolidation beat storm risk over the long run. Both of those stories are true at the same time. That's not a contradiction. That's the actual business. Owning one small marina means you're exposed, personally, to the Southport outcome, a single storm season that can tie up your capital and your legal calendar for years. Owning, or backing, a portfolio of 100 marinas spread across different coastlines means the storm that wrecks one property barely shows up in the numbers, while the scarcity premium on the other 99 keeps compounding in your favor. Which raises the real question this video's been building toward. Is a marina actually a real estate investment, or is it an insurance and legal bet wearing a real estate costume, where the size of your portfolio decides which side of that bet you're actually on? So which version of this business would you actually be signing up for? Best case, you're the Blackstone version. You're not buying one marina. You're buying scarcity itself. Across 100 properties, the government will basically never let anyone build a competitor to. Storms hit some of them every year, sure, but spread across enough coastline, no single hurricane can touch the whole portfolio at once. Revenue stacks 5 layers deep, from slip rent up through fuel and dry stack and retail. Cap rates stay tight because everyone else wants in too. On this version of the spreadsheet, a marina isn't really a marina. It's infrastructure with a view. And infrastructure is exactly what pension funds and sovereign wealth are hunting for right now. Worst case, you're the Southport version. You bought one marina, in one location, insured the ordinary way, instead of the marina-specific way. One named Storm rolls through. And the very features that made the business simple, the boats, the docks, the water, turn into 185 separate legal disputes and a rebuildable bill that dwarfs a year of revenue. The lease under your feet is suddenly a live negotiation instead of paperwork, and the passive income you signed up for becomes a second full-time job, spent on the phone with adjusters and lawyers instead of walking the docks with a clipboard. Same asset class, same water. Completely different outcome, decided almost entirely by how much of the ocean you were exposed to, and how well you'd actually read the fine print before the storm arrived. Here's the thing nobody tells you when they hand you the brochure with the white hulls and the clinking halyards. You never bought the ocean. Nobody ever does. You bought a lease, a permit, and a bet that the water stays calm long enough for you to collect the rent. And out on the coast, the water doesn't sign long-term contracts with anyone.